Hi, welcome back to this, my sixth data update for 2026. In this session, I want to turn to something that should be very fundamental for businesses, which is that your end game as a business is to make money. I know that sounds profoundly immoral and unethical, but I'll come back and deal with those critiques. But if a business doesn't make money, it can't do any of the other good stuff you want it to do for society, for the world. So in this session, I want to look at profitability, how companies' profitability unfolded in 2025, which sectors did well, which sectors did badly. And along the way, we will have no choice but to talk about the threat of AI, how it's going to change the profitability landscape, whether it's going to make companies more or less profitable, and which sectors are going to be most impacted. I will also, in the process, tie this session to my last session where I talked about the opportunity cost, which is it's not just enough for a company or a business to make money, it has to make enough money to cover the opportunity cost of the capital invested in that business being invested elsewhere. So we have a lot on our plate. Let's get started. In 1970, Milton Friedman, in an article in the New York Times, talked about the social responsibility of a business being to deliver and increase profits. He said everything else is secondary. Now, I know a lot of people believe that Professor Friedman is old-fashioned, he misses the changes in the world, and that view came under attack almost immediately, but much of the initial disagreement was about details. There were some who argued that it's not profits but cash flows, but Professor Friedman's response would have been economic profits are cash flows. There were some who talked about the long term versus the short term. And again, Professor Friedman's response would have been, there's nothing in what he said about short term or long term that the responsibility of a business to deliver profits, perhaps over the long term, might be better than over the short term. So the initial critiques were more about the details. People kind of bought into the notion that businesses should be about making money. Somewhere in the 80s and the 90s, you saw another critique develop, and this was much more fundamental. The argument here was arguing that a business should be about making money was taking too narrow a view of the world, that businesses had other responsibilities to society, to the planet, and they should be incorporating those concerns into their decision making. There again, initially, the critique was not that far-founded. It was about adding constraints to your objective, that you should maximize profits subject to the constraint of being a good corporate citizen. And I'm not sure Professor Friedman would have disagreed with that statement as well. He'd have argued that the role of government was to introduce those laws and regulations to prevent side costs. But as an economist, he'd have been willing to concede there are externalities which governments might not have been able to pass laws and regulations around, that companies should incorporate those. But somewhere along the way, those critiques decided to go for the jugular. In what sense? Rather than arguing that these should be constraints on an objective of maximizing profits, they argued that this should become part of the objective function. Initially, it showed up as the notion of stakeholder wealth maximization, where the argument was business should maximize the wealth of all stakeholders. Who are stakeholders? In addition to shareholders, I guess lenders, customers, employees. Sounds incredibly good because you want everybody to be better off, and this seemed like an objective that left everybody else better off. Now, there were practical issues. People very quickly ran into putting stakeholder wealth maximization into practice. And anybody who's run a business should have very quickly seen that coming. But about 20 years ago, you saw stakeholder wealth maximization supplemented and then replaced by ESG, an acronym that took off like a rocket and got buy-in from the establishment, including the biggest investment funds, consulting firms, corporations. And in fact, when I looked at ESG for the first time in 2020, it was because of that buy-in. I was just surprised that an idea or a concept had taken off this quickly. And I must confess, I was severely disappointed. I went in looking at ESG, expecting to see great payoffs for investors, those alphas they were talking about. And I discovered that almost all of the alpha, in fact, let's take the almost out, all of the alpha that was being attributed to ESG was accidental alpha. Accidental in what sense? ESG initially was focused around technology companies. Having a small carbon footprint led them there. And those companies did really well in the last decade, and ESG rode on the back of technology firms to deliver the alpha. When I looked at companies, where Larry Fink was telling me that companies would become more valuable if they adopted ESG, I could not find an iota of evidence that ESG increased revenue growth or margins or cash flows. In fact, what I found was the opposite, that adopting ESG made it less likely that you could scale up, actually reduce profit margins. In fact, the only dimension where ESG had any promise was on reducing risk, but even there it didn't show up as lower cost of capital. If at all, it was an anecdotal evidence that maybe if you stepped over the line, you could have catastrophic or reputational risk. So ESG, in fact, over the last 5 years has faded partly as a result of its own contradictions. And it has been replaced. The gravy train has to go somewhere. People were making tons of money, consultants, bankers, measurers, and they're not going away. So they decided to take the ESG framework and give it a new name. I mean, essentially, if you look at sustainability and you break it down, it's just the ESG space repackaged. But painting lipstick on a pig and then debating what color lipstick looks best is missing the point. Ultimately, all of these different alternatives to maximizing profits as an objective share, I think, the same common weaknesses that causes them to fall apart when you look at them closer. I call them the theocratic trifecta. And the title I attached to them is actually deliberate. Theocratic in what sense? They're all built around virtue. They lead with virtue and make business arguments next. And that's not a good idea. Because when you lead with virtue, you've already assigned the goodness to yourselves. And anybody who disagrees with you is not just disagreeing with you, but they're evil, they're bad. It becomes very difficult to bring in improvements that you should take. So that's the first problem. The second problem with all of these measures is they left the definitions diffuse. In what sense? Well, if you look at the definitions of ESG and you ask 100 people who track ESG what it measures, you're going to get 100 different definitions. It shows up in ESG measurement services, which attached very different scores to the same company because their basic scoring mechanisms reflect disagreements about what's good or bad. Now, and the same thing can be said about sustainability and stakeholder wealth maximization. It's basically you can adopt whatever and this is great if you're selling this idea to people because you can morph it to whatever a company wants it to be. But the problem with not defining something clearly is twofold. One is that you're not going to get any consistency. ESG fell apart partly because of its inconsistencies. And second, you are essentially letting companies do whatever they want and use your metric to cover up that bad behavior. And there's a third and final feature of all of these, all three, stakeholder wealth maximization, ESG, and sustainability, that I think undercut them in the long term, which is that they all deliver this promise that you can be good and become more valuable. You can be good and become more profitable. You can be good and earn higher returns. In other words, you can have goodness without sacrifice. And that cuts me at its that to me at its core is the lie that's destroyed all of these. Because being good should require sacrifice. So if you want to make the world a better place, go out and do it. If it's your own business, of course you should do it. And recognize that doing so will often make you less profitable and less valuable, but you're okay with it because you wanted to do good. So I think after all of this debate over the last 50 years and alternatives to Milton Friedman's original thesis, I think we're back to recognizing that maybe Professor Friedman was right after all, that the end game for a business should be about making money. And acknowledging that will then allow us to ask the follow-up question, given that businesses are profit seekers, how do we induce businesses to do good for society, to curb their side costs? Now, I don't think the disclosure route that many have adopted is going to do much. It's going to make companies look good, not do good. And I have a feeling that it's going to do more harm than good. What do I mean by the disclosure route? You see this with the requirements that companies disclose what they do on the E, the S, and the G. Now, I know laws and regulations would be the economist's response to it, and they can be a partial fix. And I think we've given up too quickly on creating laws and regulations that make businesses behave better. But ultimately, we, consumers and voters, get the businesses we deserve. So if we don't want to sacrifice, no, we don't want to sacrifice how we live, then we shouldn't expect businesses to be able to do it for us. So I know it leaves this process open, but I think that's a much more honest place to start this debate. So with that lead in, let's talk about profitability. When you look at how to measure profitability, I mean, Milton Friedman was talking about economic profits, but the reality is the world we live in, it's accountants who measure profits. So if you don't understand accounting, you're already at a disadvantage. The good news is, though, accounting is not deep. Anybody should be able to get the basics of accounting. And that's all I know, so I'll pass it on to you. So you look at an income statement, of course, you start with revenues. You net out cost of goods sold, the cost of making the stuff you sell. You get gross profits. You subtract out the expenses, operating expenses that are fixed, that are not directly associated with the products and services. Subtracting out gives you operating profit. Then you subtract out interest expenses and add an income from not just cash you have, but from financial investments in other companies. You get pre-tax profit. You pay taxes. You end up with net profit. So that's basically the income statement for most companies around the world. With IFRS and GAAP, you're getting a convergence on the rules. So let's start by looking at how much money companies made across the world in 2025. What I've done is broken companies down by S&P sectors globally and in the US. I have 48,156 companies in my global sample, 5,000, and all I've done is added up the numbers on revenues, gross profits, EBITDA. So let's look at the aggregated values. Globally, companies generated $24.5 trillion in gross profits on $72.4 trillion in revenues. By the time you subtract out the operating expenses, you end up with EBITDA of 11 trillion. You subtract out the DA, you end up with operating income of 7.6 trillion. Then you factor in taxes and other stuff, including interest expenses, you end up with about 6.1 trillion. So if you look at the US, a substantial portion of global revenues and profits come from the US. The US accounts for about 19.7 trillion in revenues. But by the time you get down to the net income, it's 2.2 trillion. So about a third of all net profits around the world come from US companies. The problem, of course, with focusing on absolute profits is you can't compare across companies and across sectors because they have different scales. That's where profit margins come in. You're scaling profits to revenues. And each measure of profits yields a margin, and you get margins. Those margins give you different kinds of information. Let's start with the gross margin. Gross margin basically captures unit economics. How much does it cost to make the next unit that you sell? You go to operating margin. The difference between gross and operating margin captures economies of scale. In what sense? If you have lots of economies of scale, that difference is going to narrow. The operating margin is going to rise towards the gross margins. Net margins capture the effect of debt and taxes. You're saying, what about EBITDA margins? EBITDA margins are a rough proxy for capital intensity. The only reason operating margins and EBIT margins are different is because of DA. And for the DA to be large, you got to have a lot of capital intensive products. So each margin tells you a different story about the company, and they all have relevance. So let's take a look at margins in 2025. If you look at margins in 2025, again, I've broken down by sector. Here's what I've done. I first computed an aggregated margin, gross, operating, and net margin. You see, what are you talking about? I just add up all of the revenues of all of the companies in each sector and all of the profits, and I divide the aggregated numbers. Think of this as a weighted average margin for the sector. So when you look at communication services, the aggregated operating margin is 18.06%. You see, what are the other columns? For each of the margin definitions, I've also looked at individual company level margins and looked at the distribution. So if you look at the median operating margin for a communication services company, it's 4.11%, well below the aggregated value. You're saying, what does the difference tell you? It tells you how top heavy this sector is, how much larger companies in this sector, how much more they deliver as profits than smaller companies. And across the board, you can see that there's a top heaviness to the margins. Larger companies account for much higher margins than smaller companies. And we'll talk about why later on. So as you look across margins and you look at the most profitable sectors, Probably not going to be surprised that on the aggregated margin level, the most profitable sectors are technology, followed by, this might, and at least in the US, technology stands out, followed by utilities. Now, technology might not be surprised by, but utilities? But remember, utilities also then have large interest expenses and other costs to work through. We'll see what the net margins look like. So if you look across companies, technology has the highest aggregated margins. But even within technology, take a look at US technology, the aggregated margin is almost 25%. But if you look at the median operating margin, it's minus 0.3%. What does that tell you? There are a lot of technology companies that are losing money and have very low margins. But the large technology companies deliver enough profits to carry the entire sector. So as you look across sectors, you can see some sectors have high margins, others have low margins. The differences in gross margins tell you about the unit economics of each sector. So you can see that some sectors have extraordinarily unit economics, communication services and technology, for instance, in the US, and others don't. And those are things that you're going to see play out in the other margins. Now, of course, sectors are very broad. So I broke down margins by industry, and you can get the full list if you go to the end of the session. I have a link to it. But I did look at the businesses with the highest and lowest operating margins, so on an aggregated basis. So if you look at the business with highest margins, tobacco's at the top. It's nice to have a product or service that's addictive. Precious metals, but remember that's because 2025 was a great year for precious metals. REITs, and that might be a function of how they define revenues, but you see a lot of technology, software, entertainment, software system and application, semiconductor. So again, there are high margin businesses. And you go to the other end, you get the low margin businesses. Some elements of retail, grocery and food, electronics. I was a little surprised, but we'll talk about why that might be. Chemicals, diversified. There are businesses with low margins driven often by poor unit economics. Chemicals, the gross margins, 15.32%. By the time you get to operating and net margin, the numbers obviously drop off. Now you're saying, why do we care? Well, high margins are good, right? They are good, but they also, in my view, make you a much more desirable target for disruptors. So as you look at what's happened to software in the last few months, it's become a target for AI because its margins are so insanely high. Gross margin, operating margin. And I am not surprised that it's been targeted. And I think it reflects the fear that, that as AI comes in, even if the revenues hold up, the margins are going to drop off. Now you might say that's unfair. You should know that hasn't happened yet. And it really hasn't happened any substantial way. And it's unfair to knock down the market prices preemptively. But come on, these market prices were marked up preemptively as these companies grow out. You live by the sword, the sword being expectations of growth and margins. You're going to die by that sword. So am I surprised to see the rapid marking down of market prices? Not really. So that's basically the margin component. And it's the first place to stop when you look at comparing profitability across businesses. There is one final aspect of margins that I do want to talk about, and that's at the market-wide level. There's clear evidence of a time trend in profit margins, across all companies. So we look at the net profit margin for the S&P 500 over the century, right? Starting in 2000 through 2025. There have been ups and downs. There have been dips in 2008, that financial crisis, in 2020 with COVID. But you look at the trend line, it's clearly shifting upwards. In fact, the margins at the end of 2025 or during 2025, 13.55% are close to all-time highs. Of course, this has led to a lot of debate and discussion, and 4 possible reasons have been presented for why this might be happening. The most cynical one is that this is all accounting gaming, that the margins are going up. And as somebody who's taken issue with earnings games played with companies, I sympathize, but I don't think it can explain any of this trend, because accounting gaming can actually move profits across time periods, but they can't move them up over time. So I don't think that's the answer. In fact, there are changes in accounting, like expensing stock-based compensation and expensing R&D that should bring margins down. A second explanation is to blame the Fed, in particular the macroeconomic environment with interest rates staying low. The argument was companies can borrow money at a low rate, it should make them more profitable. The reason this doesn't hold up is the low interest rate days are done. We're back to pre-2008 rates and profits have stayed up. The other is, and I think this is an argument that's worth thinking about, is that when you look at the low rates for the last year, it's accompanied by low inflation. Companies lost pricing power and low economic growth. So I'm not sure the macroeconomic environment can explain the profitability either. A third explanation, and this is especially from those who believe that businesses are bad and the political left, is that this reflects increased bargaining power for capital at the expense of labor, and that this increase in profits is coming at the expense of wages. Well, again, there's some argument that can be made in some sectors that this is happening. But if you look at those sectors which have the greatest potential for this happening, manufacturing, that's not where the increase in margins has come. It's come from technology, where this argument is least attractive because many technology companies don't have large labor forces, Amazon notwithstanding, and you can't make this argument. There's a fourth argument, and I think for me this is the most salient one, which is the composition of the market has changed. It's become more technology companies. You're saying, so what? Think about the unit economics and the capacity to generate profits. You've shifted away from old economy companies with low gross margins to new economy companies. And if you correct for that, much of the margin increase seems to dissipate. Now, I'm not saying you shouldn't worry about all-time high margins. You're always open to economic surprises. But I do think that we need to be careful about attributing these margin increases to things that might not quite fit. Now, there's one final component to profitability that I would like to talk about, which is margins are good, profitability is good. But just because a company is making money doesn't mean it's creating value. So that's where you want to scale how much you make to how much you have invested in a business. Why? Because that capital can earn money elsewhere. So that's the basis for accounting returns. Now, one of the ways to think about differences in accounting returns is to frame them in terms of who you're estimating the returns to. So I'm going to use a structure you've seen me use before of a financial balance sheet. There are two ways you can measure accounting returns. One is to just equity investors. Equity investors get net income after all other claim holders have been built, and you can scale that net income to the book value of equity. The other is to look at the entire business, which includes debt and equity. Look at operating income, which is earnings before interest and taxes. You net out the tax you'd have paid, and you divide by invested capital. What is that? That's the book value of equity plus the book value of debt, net of cash. That's a return on invested capital. These, of course, are widely used in finance, and in my view, perhaps overused because they're accounting numbers. They come with limitations. And now I've been pretty open about the limitations, even though I compute them and sometimes use these numbers. And here are some of the limitations. This is a very long paper I have, boring paper that if you're interested you can read. And here are some of the things that can cause your return on capital or return on equity to be a misleading indicator of true returns or economic returns on capital. The first is if you have a really good or a bad year. This year, for instance, precious metals companies might earn high returns. But that doesn't mean they're great businesses because gold prices went up. There are always accounting issues. I've talked about the inconsistencies accountants have in how they classify leases, which are really financial expenses, operating expenses, and R&D, which is really a capital expense. That can skew your operating income. There's a life cycle effect that I want to talk about. And put simply, and I'll talk about it more in a few minutes, younger companies will often look bad on an accounting return base because they haven't started making money yet. The earnings don't reflect the long-term earning power. If you go to the invested capital side, here are some of the issues. One is inflation. If you bought your assets a long time ago and there's been inflation, to the extent those book values don't get adjusted for inflation, that capital is dated. It doesn't reflect the capital invested today. You have accounting write-offs. I know accountants do this with the best of intentions, but every time you write off a mistake, you're essentially making it more difficult for me to read the return on invested capital because your return on capital can look good because you took your mistakes off the book. And here again, the accounting misclassifications come in because they affect your invested capital. I argue that the return equity and return invested capital for technology and pharmaceutical firms is going to be routinely overstated because your biggest assets are not on the books because you expensed R&D. So with all of those caveats in mind, I computed the accounting returns by sector. Again, there are big differences. I've computed both the aggregated values and the distributions of the company level returns on equity and capital. So no surprising, given what you saw in margins, it's top heavy. The bigger, the larger companies account for much of the high returns in these sectors, much of the profitability. And again, if you look across sectors, you see big differences. Let's take the US broken down by sector. Technology's aggregated return on invested capital is 49.67%. And that's with me trying to capitalize R&D. But again, the median number is much lower. The typical technology company doesn't create value, but in the aggregate, technology creates value. And if you look across sectors, you can see that there are sectors that are struggling. If you look at materials, 6.57% return on equity, though the return on invested capital is not bad. Utilities, 7.57% return on invested capital, the return on equity is not bad. Clear differences across sectors. And the one thing about financials is don't get thrown off by the return on invested capital because it doesn't really mean much. The return on equity is what matters. And again, in the aggregate, financials don't look pretty good, 14.85%. So look at both the aggregate and the sector and the distributional numbers because each carries information. Now those are returns. Now what do we compare them to? You compare them to what you could have made elsewhere with your money. And that's where the cost of equity and the cost of capital come in. They're what you can earn on investments of equivalent risk. If you're computing return invested capital, you should compare to the cost of capital. That spread is called the excess return to capital. If you're computing return equity, it should be compared to cost of equity. That spread is called the excess return to equity. So I computed excess returns, but before we look at the numbers, it's worth remembering where those excess returns come from. They don't come from accounting statements. They don't come from, finessing the ratios. They come from comparative advantages. In fact, you can look at comparative advantages because in a world with no comparative advantage, there will be no excess returns. In fact, there are two dimensions on which you can measure comparative advantages. One is how strong is the comparative advantage or how wide is it? And you can capture that as the width of the moat. So as an example, with the brand name, if you have a top brand, you have a very wide moat. If you just have a name brand, people recognize it's a narrower moat. If you have no brand, of course, there's no moat. It's generic. If you look at cost advantage, so permanent cost advantage, an example would be Aramco's 300 million barrels of oil under the Saudi sands. That is a wide advantage. It could be a temporary cost advantage. You have, a factory that is much more equipped to modern equipment, so it's making stuff, cheaper than it's temporary because other people are going to do the same thing. So with each competitive advantage, and I'm not a strategist, so I might be missing a few: brand name, switching costs, network benefits, cost advantage, legal protection. I've looked at a range of it. So you're looking at the width of the moat, and the other dimension in which you measure moats is how long will this moat last? The depth of the moat. So basically, you're looking at both the width and the depth, and basically asking the question: how long will what are my competitive advantages? How long will they last? So as you look at these excess returns by sector, think about moats and competitive advantages. Because again, across sectors, you have very different numbers. If you look at US sectors, technology has the largest aggregate. I'm going to focus on the aggregated numbers, aggregated spread, reflecting, I guess, the biggest competitive advantages. And as you look across businesses, again, you see the top heaviness. Larger companies in every sector are more likely to deliver excess returns than smaller companies, but there are big differences in excess returns across sectors. I also track what percentage of companies globally deliver more than their cost of capital, and it's a truly depressing statistic. Globally, only 28% of companies earn more than their cost of capital, and roughly 28 to 29%. And in the US, it's about the same percentage. 70% plus of companies have trouble earning their cost of capital and cost of equity. So as you look at these excess returns, the message that should come through is how difficult it is to generate excess returns. So while consultants and bankers talk, blithely about, hey, you can go out and make more than your cost of capital. It's worth remembering that it's really difficult to do. Now, as you're looking at the percentage of companies that were able to earn more than their cost of capital, I've also looked at the companies that earn at least 5% more than their cost of capital, a higher threshold, and there the statistics obviously get even worse. Only 18% of global companies are able to earn more than a 5% excess return. And in the US, it's about 17% on a return on capital basis. And if you look at the percentage on an equity basis, slightly higher, but not by much. So the bottom line is most companies globally have trouble earning their cost of capital, but larger companies are more likely to succeed. Now, I did look by region to see if there were differences across region. And there are some interesting differences. First is if you look at the aggregated spread, there are only two parts of the world where that number is positive. One is Africa and the Middle East, and that might be because markets are smaller, protected from global competition, and the other is the US on an aggregated basis. But even in the US, if you look at the percentage of companies that earn more than the cost of capital, you get statistics that are obviously pretty bad. 24% have positive returns if you're looking at return on capital, and about 28% if you're looking at return on equity. So while the US does have aggregated values that are pretty, that can look impressive, many companies in the US obviously have trouble earning their cost of equity and capital. So again, as you look across aggregated spreads, now one of the interesting questions is why might a spread be positive to equity investors and not to invested capital? That might be either because you have subsidized debt in some parts of the world or because equity is more likely to be volatile. So those spreads will be much more. So if you're looking at spreads across time, returns on invested capital versus cost of capital spreads are more sustainable. They're spreads that capture the true value of the business. The equity spreads might be capturing good times better and might look much worse in bad times. So with that long discussion of excess returns, let me go back to what I said about where you are in the life cycle. I have a bit of an obsession with the corporate life cycle. And one of the things you can look at is how the returns on capital and return equity, the accounting returns will shift over the life cycle. And as a consequence, excess returns. Early in the life cycle, startup and young growth, you're losing money. You're going to have negative returns on equity, negative returns on capital. Obviously, you're going to have negative excess returns, but it's not going to be reflective of the true quality of the business. Excess returns become almost useless, as are accounting returns. As you go into high growth, you start to make money, but your returns on capital will still be small relative to your cost of capital. Why? Because you've just started to make money. You will underestimate business quality using excess returns when you're in high growth. Mature growth, you'll break through. That's when you start to see the moats kick in, the competitive advantages you have. And as you see that, you'll also see the level of excess returns climb. You're going to climb above the cost of capital. How long you will stay there will depend upon how well equipped you are to deal with competition. And in stability, that becomes the test, is how much can you keep the competition away. And you might be at peak return on capital for a long period if you have a very sustainable competitive advantage. When you go into decline, both your profits and your invested capital decline. In general, your returns on capital and excess returns will decline as well. So when you look at an individual company, keep this as part of the life cycle in mind when you look at its current excess returns. So I did break down US and global companies by corporate age, by when they were founded through today. So from youngest to oldest. And if you look at this table, there's rough support for the life cycle hypothesis. Let's, for instance, look at the percentage of companies that earn more than their cost of capital. As you go from youngest to oldest for both, global and US companies, more so for US companies than global, you see the percentage of companies that are able to earn more than their cost of capital tends to rise. If you look at the aggregated spreads, though, they tend to rise initially, but they're all over the place. The middle of the distribution, middle-aged companies seem to have the highest spreads for both US and global companies. So again, where you are in the life cycle seems to matter in whether you can earn more than the cost of capital / cost of equity and how much more. So if I were to wrap up this session, I think that as I look at these numbers, and I've been looking at them for close to 3 decades now, my sense is it's getting more difficult to succeed as a business in terms of creating value than ever before. You can blame globalization, you can blame disruption. The business board has tilted also towards larger companies. So it's more difficult for individual companies to earn more than the cost of capital. But larger companies have more of an advantage. And it's in this context that I think I have a much more jaundiced view of AI and what it'll do for company profitability and value. I know, in my view, AI is going to put downward pressure, at least in the aggregate, on companies. Companies will collectively become less profitable. Now, that might seem like it's going contrary to what AI advocates argue, which is that AI will make companies more productive. I actually agree with that. AI will make companies more productive, but here's how I reconcile my view of the end game versus theirs. I think AI will make companies more productive, it will help them reduce costs. But unless it's exclusive, it'll reduce costs across the board. Now, the analogy I would offer is think about what online retailing did to retailing as a business. It actually put downward pressure on it doesn't mean there won't be winners in the space. The Amazons, the Costco's, even the Walmart might be winners, but most companies will end up losing. And I don't think it's going to happen overnight. It's going to be like a slow motion car wreck to see these profitability numbers slide over time. Though some sectors like software, the slide might be much quicker. I know that goes against the conventional wisdom, but time will tell. I hope you found this session useful, and I thank you very much for listening.